Hello everyone, and welcome back to Explain the Charts. Today is November 19th, 2025, and we are taking a close look at the SPY, the S&P 500 ETF, which is currently facing significant headwinds. The market has just posted its fourth straight day of declines, and there's a tangible sense of fear creeping in among investors. In this video, we'll break down the news driving this sentiment and then dive into the charts to see what they're telling us. First, let's talk about the news, because the headlines are painting a concerning picture. Multiple sources are reporting a broad market skid, with jitters around a potential AI bubble and a significant crypto market collapse weighing heavily on speculative assets. The recent $1.2 trillion sell-off in cryptocurrencies is being seen as a red flag for retail trading sentiment, which can often spill over into equities. Adding to the pressure, Home Depot's stock dropped after cutting its outlook, citing a slowdown in home improvements due to high mortgage rates. This signals potential weakness in consumer spending, a key driver of the economy. All eyes are now on Nvidia's earnings, which are due on Wednesday. This report is being viewed as a critical test for the health of the entire AI-fueled rally we've seen this year. We also have the long-overdue September payrolls data coming out, which is expected to confirm a labor market slowdown. So, the macro environment is filled with uncertainty and major potential catalysts. Now, let's turn to the daily chart and see how this news has translated into price action. Looking at the bigger picture, we can see the market put in a recent high around the 685 level in late October and another lower high near 683 just last week on November 12th. This pattern of lower highs is a classic sign of a weakening uptrend and a potential reversal. Yesterday, on November 18th, we saw a significant drop, with the price closing at 660.08 after hitting a low of 655.86. This move decisively broke below a key support area around 670, which had held throughout early November. That broken support at 670 will now likely act as major resistance on any potential bounces. The volume on these down days has also been increasing, suggesting conviction from the sellers. The next major support level to watch is the low from October 10th, which was a sharp drop down to 652.84. If that level fails to hold, we could be looking at a deeper correction. To get a better look at this recent topping formation, let's zoom in on the chart from the beginning of October. Here you can clearly see the multiple attempts to break higher that ultimately failed, leading to this sharp move down over the last 4 sessions. The price action on October 10th, that massive red candle with a huge range from 673 down to 652, was a major warning sign. Although the market recovered from that drop, it failed to make a convincing new high, and now we are retesting the lower end of that range. This price action is technically very bearish in the short term. Switching over to the 1-hour chart gives us an even clearer view of the recent breakdown. We can see a clear downtrend has been established since the peak on November 12th. Each bounce has been met with selling pressure at lower levels, forming a staircase pattern downwards. The breakdown below 670 was a critical technical event on this time frame. Notice how the price tried to rally yesterday morning, but was firmly rejected right at that 665 level, which now acts as immediate, minor resistance. The selling accelerated significantly in the afternoon, which corresponds with the news about increasing market jitters. Now, let's drill down to the 15-minute chart to see the intraday price action from the last few days. On Monday, November 17th, we gapped down and spent the day in a weak range before a late-day sell-off. Then yesterday, November 18th, after a weak open, we saw a very aggressive sell-off midday, taking us from around 663 all the way down to that session low of 655.86. While there was a small bounce into the close, the overall structure remains extremely weak. Any attempt to rally this morning has been feeble so far, suggesting sellers are still in control. The key battleground for today will be that 655.86 low. So, let's go back to the daily chart and discuss the reasons to be bearish or bullish from here. The bearish case is quite strong right now. We have a confirmed short-term downtrend, a break of key support, increasing volume on down days, and a backdrop of negative news. The uncertainty surrounding Nvidia's earnings could lead to further de-risking and selling ahead of the event. If bears remain in control, the primary target is the October low of 652.84. A break of that level could open the door for a move down towards the 645 area, which was a consolidation zone back in late August. Now for the bullish case, which is currently the counter-trend argument. Bulls could argue that the market is getting oversold in the very short term after 4 straight down days. This could lead to a relief bounce, especially if there's any positive news. The main catalyst for a bullish reversal would be a blowout earnings report from Nvidia. If Nvidia surprises to the upside, it could invalidate the AI bubble fears and trigger a massive short squeeze. For a bullish reversal to gain any traction, buyers would first need to reclaim the 665 level and then push through the major resistance at 670 to 672. Until then, any rally should be viewed with skepticism. To recap, let's lay out the most important price levels and potential scenarios. Your key support levels to watch are the recent low at 655.86 and the more significant October low at 652.84. To the upside, immediate resistance is at 665, with the major hurdle now being the 670 to 672 zone, which was our former support. Now for some unbiased predictions. Scenario 1, which I believe has about a 65% probability, is for continued weakness or choppy consolidation heading into Nvidia's earnings. We will likely test that 652.84 support level. If Nvidia's report is disappointing or even just in line with expectations, the market could sell off further, breaking 652 and heading towards 645. Scenario 2, with a lower probability of around 35%, is a sharp reversal. This would almost certainly require a major positive catalyst, like a stunning report from Nvidia. In this case, we could see a powerful short covering rally that quickly pushes the price back up to test the 670 to 672 resistance. A clean break above 672 would be needed to suggest the bulls are back in control. The main thing to watch for is the market's reaction to Nvidia's earnings on Wednesday. It is the single biggest known catalyst this week and will likely set the tone for the rest of the month. That's our analysis for today. Thank you for watching Explain the Charts. If you found this helpful, please like, subscribe, and hit the bell for notifications. And now for our disclaimer. This video is for informational and educational purposes only and is not financial advice. Trading and investing involve risk, and you should always conduct your own research and consult with a professional before making any investment decisions.